Hello! In this video we are taking a look at Zoom, which reported earnings and it's down 8% again today, continuing its down trajectory and not allowing Cathie Wood to catch any breaks here. I mean, this is their second largest holding in terms of the ARKK fund. And again, it's down 8% today in a total of maybe 75 to 76% when the markets open tomorrow, sitting at $90 it looks like. If not for going to be a little bit less, we'll see. But this stock has been, of course, completely devastated. You can take a look at the 3 years chart and you will see that it was going up and up and up and up in the COVID pandemic period. And then as it slowly starts dissipating, the company is not making as much money as they were. And not so many people are using Zoom as they were, because people are finally going out, I suppose. Although still, this is pretty much a software that a lot of the big companies are using, and it's still very relevant, and it's a great company. The thing is, it has dropped so much that it used to be super expensive, but is it still that expensive? This is what we're going to be analyzing in this video for sure. But first things first, we do want to see what happened at the earnings report. So I do have it here. Let's take a little bit of a look here. Now you will see that Zoom pares back annual forecast as revenue growth slows to single digits. And this is fire. This pretty much sentence here is fire for the Wall Street. They hate that. When there is a revising of the forecast, the Wall Street absolutely hates that. And this is probably one of the core reasons why the stock is down right now. This is so-called guidance for the upcoming quarter. Now, revenue growth slows to single digits, but the last year's one was 12%. Right now it's 8% compared to the previous quarter. A little bit less than expected, but still, frankly, pretty nice here, I believe. Now, in terms of earnings here, the EPS was better than expected, 1.05 towards versus 94 cents that were expected. That's pretty good over here. And in terms of revenue, 1.10 billion versus 1.12 billion, a little bit less, but still very, very solid here in terms of what the company did. Now, the company did blame the strong US dollar pretty much for their performance, which definitely does play a role here and impacts their revenue in the quarter. Okay, but you will see that the big thing here is the guidance, because they called for fiscal third quarter earnings of 82 cents per share, 82.23, and 1.95 to 1.1 in revenue. That is a billion, of course. And analysts were actually expecting 91 cents, which is a pretty steep decline here, and 1.15 in terms of revenue, but the EPS seems to be going down quite a lot here. Now, they also provided guidance for the full fiscal 2023 pretty much, and you will see that there is a little bit of a miss here in terms of what was expected. 3.66 to 3.69 versus the expected 3.76 here. And revenue that they are expecting 4.3 to 4.4 almost, and the expected one was significantly higher actually, 4.54 over here. So yeah, things are not looking that great here in terms of what the company will be doing in the upcoming quarter and year pretty much, and this is why we're looking at a little bit of a decline right now at the company stock price, which has already been annihilated immensely really. Now, Cathie Wood, of course, will be once more one of the people to talk about, because here ARKK fund is actually already down 52%. And the thing is, if you take a look at their holdings, the holdings of the fund, Zoom is actually the second largest holding here at $700 million. And it's actually 8.39 of the whole ETF here, which means that the ETF, if Zoom is down almost 10% tomorrow, the ETF is probably just going down 2 to 3% just because of this, maybe a little bit less, just because of this holding here. It's going to have an almost 10% impact on the holding. So it may be going down like 2%, maybe something of that sort, maybe a little bit less actually. But still, it's going to play a significant role in what the ETF is going to be doing tomorrow. And again, it also depends on what the other companies are doing. And currently, we are looking at a potentially a little bit of a negative market right now, but we'll see. But this will definitely play a role. And yeah, this has been absolutely destroyed here, as you'll see. And still, investors are paying 0.75% to actually own this crap. Okay, that's insane to me. But okay, let's go back and take a little bit of a look here at our tool. Because Zoom, again, it has fallen a lot, and it may actually be in buy territory. And we do want to examine the numbers, because the P ratio is sitting at 24, and take a look at this one. It's actually going down and down and down, and compared to what it used to be, right now it's doing much better, significantly better. The price to free cash flow is sitting at almost 20 over here. And the outstanding shares, they are actually higher than what they used to be, because the company has been issuing shares, but you'll see that they slowed down how much they were issuing, which makes a lot of sense, because back here in 2021, for example, the stock price was much higher than what it is right now, so it was overvalued a lot. But right now, maybe it doesn't make that much sense to be selling into this weakness here, because it makes probably more sense to be buying right now instead of issuing more shares. It doesn't make a ton of sense. Now you'll see that the key metrics here in terms of the growth look amazing and absolutely out of the ordinary here. And don't pay too much attention to the actual number here, because this starts from 5 years ago when revenue was actually near zero. But what you need to be paying attention to is the overall growth over here, and this is why you want to be examining the actual chart that I'm having here, which points to very nice growth through the last few years, really, which is nice to see. And another great thing to see for the company is that it's very solvent. Total liabilities to free cash flow 1.21 years, so a lot of free cash flow last year to pay back all the total liabilities that the company has. Very solvent, and very low debt to equity ratio as well, with great net income margins. Again, it's a software company, and great returns on equity as well. So great things here for the company, which is looking a little bit enticing here. Now I'm going to take a look at the financial statements just a little bit here, and you will see that, again, very little revenue to begin with, but then 4.1 billion. Of course, the pandemic helped a lot over here, and they grew their bottom line as well, from losing money to making 1.3 billion. That's pretty nice, amazing growth, really. It's a household name pretty much right now, Zoom. Everybody knows about it. While some years ago, I was using it in a company, actually, and I'm not really sure that people were actually really aware of the name at all. But yeah, they have been doing very well and very quickly, I believe. In terms of total equity, for 5.8 billion here almost, and the total liability is 1.7 billion. And again, remember, this is almost the amount of free cash flow that they made last year, because they did make 1.46 last year. So they're very solvent. They can pay back almost all their total liabilities very quickly. And you will see here that they are making operating cash flow that is positive 1.6 billion, and the stock-based compensation is quite some, but it's not like too much, I suppose, although it's been growing. And yeah, free cash flow from 10 million to 1.46 billion. Not too shabby, right? So that's pretty nice over here. Now, what else do we need to be taking a look at? I kind of want to take a look at what analysts are saying here. I do have a module here which kind of shows what analysts are thinking about the company. Now, some analysts are implying that they have a price target of 91, and you will see here price target of 135. Overall, most people are actually kind of in the green here, so positively thinking about the company. And the other things that I want to see, and again, we can use our tool here. Remember, you can gain access to this tool and do it for any stock that you like, really. And just by becoming a patron, you can find a link in the description box below this video and join us. And you will see here we have insider trades, and I kind of want to examine two things when I'm looking at this one, because you can see all the trades that are happening. A lot of these are awards, like are actually almost compensation for the shareholders and executives. So sales are very normal to see. What I do want to see is potential purchases, which I'm not really seeing here. You could be seeing a green sign here with a purchase, so pretty much a symbol. There are none of these. This would indicate insiders buying with their own money, pretty much, which is always significant. And the next thing that I want to take a look at is the CFO, the Chief Financial Officer. It's either CFO or Chief Financial Officer is going to be like over here, their role. And I want to see whether they actually sold or bought a lot. We know that nobody bought, really, but in terms of sales, did they actually sell a lot of their own securities? So they do own a lot, like 700,000. So if you see very significant lots here, that could be interesting. Like this one is a buy, but it's not really a buy, it's an award here. This is why you're not seeing it as a purchase here, because it's an award. It's actually part of their compensation. It's restricted stock units here. And they haven't been selling anything, frankly, any big numbers here in terms of stock. So that's actually interesting to see as well. In terms of senator trades, which I always want to kind of monitor a little bit, you will see that they have been selling for the most part, and last sales back in January 2022, pretty much this year, just a few months ago. And yeah, these are sales, as you'll see. They sold quite some. As the stocks were falling, I suppose, as Zoom was falling, they started selling quite a lot. These are pretty big lots as well. Of course, you can always click on the download link here, and it will take you to the actual report if you're interested in knowing exactly what this senator sold and when. very, very useful just to click and get it. And okay, the next thing that I want to examine here, I do want to see what our stock evaluation tool will tell us about the company. This is the most important thing, frankly. Is it a buy? So the revenue growth of the company has been about, as you'll see here, has been about 140% through the years on average, because of some outliers, of course. But we can't go that far. We have to go much, much more conservative. We know that the company is projecting to grow at about like 10% or something of that sort, and that's for the quarter. And so we're expecting pretty high growth, generally speaking, but I'm gonna go, let's just go 15, 20, and 25. This is still a company that seems to be growing very nicely. This may be very aggressive, frankly, but let's just try that and see what we get. Now, the net income margins, they are doing great net income margins lately, and so I'm gonna have to go a little bit high. So I'm gonna go 25, 28, and 31 here. And for the free cash flow margins, we're going to normalize it somewhere between 100, because again, it has been a little bit all over the place. The company has been growing massively through the final years, so through the pretty much the last 2 or 3 years. So I'm going to go 80, 90, and 100, somewhere around what is a typical thing for most companies. 13% for annual return is the usual one that I like to ask for my stocks, for my companies. And I hit calculate here, and you will see that I'm getting green for a medium and my high. Pretty much projection is here, and the low projection, the low revenue growth one, which is sitting at 15% and 25% net income margin, which I think frankly is going to be higher, even though the average is low. Remember that the company started with bad years and then grew to better years because of the pandemic, but they seem to be normalizing. Now, you may want to wait it out a little bit, see if this trend continues, but if you are actually confident about the company, it may be worthwhile to potentially buy a little bit, especially if it keeps going down even more. So right now we are sitting at 90s. With these projections, it is a buy, of course, for the medium and the high ones as well. The current price is showing at 97. Remember, it's down already about 8 to 10% after hours. So this is going to be 90 tomorrow. So, you know, if it goes down a little bit more, maybe $80 or $70, it may be very, very interesting actually for holding a little bit of Zoom, frankly. Now again, if you are a little bit of a less risky investor, you may want to wait it out a little bit to see what they're going to be doing in the upcoming quarters, but I think they're going to be growing nicely, frankly. So thank you for watching this video, guys, and remember to like it. That helps a ton, guys. And thank you for being around and being a subscriber. If you're not one, of course, become one. And in the meantime, take a look at the video that I made earlier, in which one I'm explaining why it's not a good idea to be investing in stocks like AMC, which is down like 40% today again. Absolutely terrible for this kind of meme stocks. And thanks for watching this video. I'll see you in the next one. Bye bye.